What's up, my friends? So, if you are self employed and you've been told that you don't make enough money to buy a house, even though you know damn well you make enough money, this video is going to change how you see the entire mortgage process. Because here's the thing, the problem isn't your income. The problem is how your income shows up on paper. And there's a specific loan product that completely sidesteps that paper problem. I'm going to break down exactly how it works, how to figure out if you qualify, all in the next few minutes. Quick heads up though, if you're serious about this and you want to get started, there's a link in the description where you can book a strategy call with my team to see if you qualify or to get any of your questions answered. All right, so let me set the stage before we jump into this. You're a business owner, you're a freelancer, a contractor, whatever it is, you're doing well. You're depositing real money every month, but you're CPA, and I love CPAs. They're doing exactly what they're supposed to do. Your CPA sits down with you at tax time and goes, let's write off everything we can. Home office, vehicles, supplies, travel, meals, depreciation on equipment. And that's smart. That's literally their job. But here's what happens. Let's say your business brings in $150,000 a year in actual revenue. Your CPA writes off $80,000 in legitimate business expenses. Your Schedule C, that's the form on your tax return that shows profit or loss from your business, now shows $70,000 in net income. And when you go to get a traditional mortgage, that $70,000 is the number that the lender uses, not the $150,000, the 70. So your buying power just got cut almost in half. I had a client last year, owns a landscaping company, deposits $18,000 to $22,000 a month into his business like clockwork. The guy's been doing it for years. His tax return shows $52,000 in net income because his accountant correctly wrote off his trucks, his equipment, his fuel, his crew costs, went to a traditional lender and got told he could only afford a house in the low 200s. He was looking at houses in the mid fours. That disconnect right there is the entire problem we're solving today. Now, I'm going to show you the solution, but there's a part of this that most people get wrong about how income actually gets calculated. And that piece alone could be the difference between qualifying and not qualifying. And we'll get there in a minute. So the product is called a bank statement mortgage. And here's the plain English definition. It's a loan where the lender looks at your actual bank deposits over the last 12 to 24 months to figure out your income instead of looking at your tax return. That's it. No W-2s, no Schedule C, no pay stubs, just your deposits. Now, it falls under a category called non-QM, which stands for non-qualified mortgage. That just means it doesn't follow the strict conventional lending rules that were designed for W-2 employees. It doesn't mean it's sketchy or risky or some back alley loan. It's fully regulated. It's fully legal. It's just built for people whose income doesn't fit into the W-2 box. Who is this for? It's for self-employed borrowers, freelancers, independent contractors, small business owners, LLCs, sole proprietors, S corps, basically anybody who files taxes in a way that reduces their reported income below what they actually earn. Who is it not for? If you're a W-2 employee with a normal paycheck, you don't need this. And if your bank deposits are inconsistent or you're not actually self-employed, this program won't work for you either. You typically need at least 2 years of self-employment history. Okay, here's where it gets good. This is the part that changes everything. Let me walk you through exactly how the income calculation works because this is where most people get confused. There are two paths depending on which bank account you use. Path one, personal bank statements. If you're a sole proprietor and all your business income flows into your personal checking account, the lender looks at your deposits, removes anything that isn't income, like transfers between your own accounts, one-time gifts, loan proceeds, and then totals up the eligible deposits over 12 to 24 months and divides by the number of months. That gives them your average monthly income. And here's the key. With personal statements, many lenders count those eligible deposits at 100%, no haircut. Path 2 is business bank statements. If your income goes to a business account, the lender applies what's called an expense factor. Think of it as the lender's estimate of how much of your deposits go toward running the business. The industry standard is 50%. So if you're depositing $20,000 a month into your business account, the lender counts $10,000 as your qualifying income. Now, and this is the part that nobody talks about, you can potentially improve that number. If you get a CPA letter documenting that your actual business expenses are lower than 50%, some lenders will use your real expense ratio instead. So if your CPA writes a letter saying that your actual expenses are only 30% of deposits, now the lender counts 70% instead of 50%. On $20,000 a month in deposits, that's the difference between qualifying on $10,000 a month versus $14,000 a month. That's massive, and that could be a six-figure difference in what you qualify for. If you want help applying this to your specific situation, figuring out which account to use, whether a CPA letter makes sense, all of it, book a strategy call with our team. The link is right below this video. We'll walk through your numbers with you. All right, so let me give you the exact steps to figure out where you stand before you ever talk to a lender. Step 1, pull your last 12 months of bank statements, whichever account your business income lands in. Add up every deposit, divide by 12, write that number down. That's your average monthly deposit. Step 2, if you're using a business account, take that number and cut it in half. That's your estimated qualifying income using the standard 50% expense factor. If that number comfortably covers a mortgage payment plus your other debts and keeps you under roughly 43 to 50% of your income going to debt, that's a green flag. If it's tight, talk to your CPA about documenting a lower expense ratio. Step 3, check your credit. Most bank statement programs need a 620 minimum, but you'll get meaningfully better terms at 700 or more. If you're below 620, you've got some work to do before this becomes an option. And look, you'll also need to have been self-employed for at least 2 years in most cases. You'll need some cash reserves after closing, and your deposit pattern needs to be reasonably consistent. If you've got one huge month and then 3 months of nothing, that's going to raise questions. Consistency matters more than one big number. One more thing before we wrap. I see people all the time who think that their only option is to stop writing things off for 2 years so that their tax returns look better for a mortgage. Please don't do that unless you've explored this first. Paying tens of thousands of extra dollars in taxes just to qualify for a conventional loan when a bank statement program might get you there without changing a single thing about your tax strategy, that doesn't make sense. At least look into it before you make that call. So if this has helped you see your situation differently, do 2 things. Book a strategy call with our team using the link in the description. We'll look at your bank statements, we'll tell you exactly where you stand, and we'll map out your best path to approval. And hit subscribe so you don't miss what's coming next. I've got more videos breaking down specific programs for self-employed borrowers, and honestly, this stuff is way simpler than people make it.